Welcome to a special video because I know that you all love strategy videos. You love when I show you how to find the best entries. Today, I've included 4 divergence trading strategies and I'm going to show you how to get into entries, where to place your stop loss, how to manage exits, where to trail your stop loss. So make sure to stick around until the end. And before we get started, I don't want to spend too much time repeating what a divergence is because I have made videos in the past and I will link them in the video description. But just to make sure that we all understand what we are looking for is, let's take a look at this price action chart. And you can clearly see that the market is in an uptrend. We have 2 trend waves. First, a very strong initial trend wave, and then now the market is making a little bit of a smaller and shorter trend wave. And when we look forward, you can see now it seems like the market made a higher high. And when we look at the indicator, we can see that the indicator is not agreeing with the price action. The indicator, whether we use the RSI or the MACD, you can also use a stochastic, for example, or any other momentum indicator. They show you that there is a divergence. The price action and the indicator are diverging. They're doing separate things. And this is a divergence in price action. And a divergence can mean 2 things. First of all, if you're in an uptrend here and if you are trading this long, it may be a good idea to get out of the trade because the divergence is telling you that the uptrend that you are looking here at is not really as strong as you may think it is. So first of all, it is good to time exits when you see a divergence. Or if you are looking for new trends, you could think about trading plans that would help you get into a short position away from the divergence, because the divergence is telling you that the uptrend here is slowing down, it is losing power. And maybe if we find the right confluence, as I will show you in a moment, then we could also think about getting into trades. And then we have a few options how we get into trades: breakouts, pullbacks, trend lines, support and resistance, and we will go through that. And you will often see that the divergence is a very, very helpful tool that we can then use later on. Like here you can see we may have had a breakout entry, we may have had a retest entry, we have a head and shoulders here, and so we can very nicely use divergences in many different ways. So let's get into the 4 strategies. Our first divergence strategy is a multi-time frame one, and I will show you how to find an amazing entry using a few interesting techniques. So we are starting on a daily time frame, and on a daily time frame I always like to look at markets where the price is reaching previous support and resistance levels, important swing highs and lows. Generally when the market is making an important turn at a specific price level and then reaching it again like here, this is always worth investigating. So that is one thing we know from our daily time frame. Now we can go to the weekly time frame, and when we turn on my favorite moving average, which is the 50 period, you can see that the market is currently trading around it. This candle isn't closed yet, so it's very interesting to see because the 50 is a moving average that is often causing reactions and the market is often trading around it. So we have a very interesting confluence here as well. And now let's drop to the 1-hour time frame where we want to get into a trade, and we turn on our RSI indicator. Again, you can use a MACD, a stochastic, any momentum indicator will work. And what we see here is our divergence. So you can see the price action is suggesting lower lows. So technically we are in a downtrend, but, and that's a very big but, the indicator is showing you here a higher low. So the price action and the indicator are not agreeing. They're doing 2 separate things, and this is a divergence. And what does it tell us? It tells us that although we are looking price action wise at a downtrend, lower lows and lower highs, the way that the trend is moving is suggesting the weakening of a trend. You can clearly see when we just look at the size and the length and the steepness of the trend waves, the second trend wave is much, much shorter than the first one. So this is how divergences are created. But this is not enough. So now we have quite an interesting scenario. We have our daily support level, we have our weekly moving average, we have our 1-hour divergence. So how do we get into this trade? And we need to wait for a breakout, for example. So this chart is offering a support area that is turning into resistance. Whenever you see those flip zones, they can be used to time your trades. For example, you could think about getting into a breakout trade once the market breaks above it. Or alternatively, you could wait for a retest and a pullback and then look for trading opportunities around here. So breakout here, retest here. And in my experience, and I've been trading for around 14 years, there's no better or worse. Some traders are more drawn towards breakout trading. Some traders prefer retest trading. That's totally up to you. And I will show you both here during the course of this video. So now let's speed up the price movement a little bit. And you can see the market is challenging the lows. And now it seems like it's moving higher and testing the highs here once again. Let's see, do we get an entry? Where is the entry? So this is not an entry yet because the market is not really breaking higher. You can see the market is just testing the levels and we haven't really broken here above the previous highs. That is very important. You want to make sure that your breakout candle is always quite strong and really suggesting momentum. Not here, not here, not yet. So that's why you can make sure that you're not sitting in those bad positions where you almost have a breakout. When it is happening, you know that probably shouldn't be in, but many traders will still jump in this despite the lack of breakout momentum. So you can avoid that very easily. And now you have a clear breakout. You can see we have a strong breakout candle. We have a very strong breakout sequence. The market is moving higher quite a bit. When we look at the broader picture, let's get rid of the divergence. We all know that there's a divergence. We can see that the market is making the formation of a head and shoulder or inverse head and shoulder in this example. You can see we make lower lows, higher lows, and we have a breakout. So this is where you could theoretically get into a trade. So let's map out this trading idea. And we want to initiate a long position. Where do we put our stop loss? Stops have to be protected and you have a few options. Are you going for the very extreme stop loss all the way above the head and shoulder? Or maybe just below the right shoulder? Or are you very aggressive and just put it underneath the breakout level? The answer for me is always somewhere in the middle. I don't think the very extreme stops are necessary. Also, the very close stops are a little bit too extreme. So my stop loss could go somewhere around here between the breakout level and the right shoulder. So we could go it somewhere in the middle. For targets, we could, for example, choose this one is really standing out, previous highs and lows. You could, for example, also throw in a Fibonacci, for example, A, B, C, and then we choose here the 200 fits in very nicely. But for the sake of this video, we can keep it simple and just think about a target maybe here at the previous highs. And let's see what the market is doing. Looks good. And here you can, by the way, let me just turn this off a bit. Here you see your retest entry. If you are not comfortable with a breakout approach here, you could have waited for the market to get back in here. And then you can see here with this engulfing body, this could have been your retest and re-entry candle. So pullbacks, breakouts, they often or sometimes happen together. And waiting for one may be something worth exploring as well. But we are in a breakout trade. It is looking good. Very strong market. So here it's struggling a little bit. At this point, you could think about moving your stop loss maybe a little bit, protecting your profits, maybe taking partial profits. It's almost at your target. So this little bit of extra room is probably not worth gambling a lot. But you can see the market did spike into it eventually. And then it is even making a little bit of a higher high. But if we would go now, for example, on the 15-minute, you will see that there is a divergence as well. And you could use that for trade exiting as well. But overall, played out very nicely. 2.8 reward risk ratio, which is quite decent and a very interesting trade study. The next strategy is a double divergence, and we're starting on the daily time frame as a higher time frame. And here we can wait for the market to give us the divergence first. And you can clearly see that the market is in a strong uptrend. And you can see here we have the market making higher highs. But when we just look at price action, we can already tell that the second trend wave here leading up to this recent high is much weaker, shorter than what we have seen previously. And the RSI just confirms that. So this is our higher time frame divergence. And once we have confirmed that, what we would do then is go to a lower time frame. For example, 1 hour. And on the 1 hour, we need another divergence. And we have that already here. You can see we have a divergence here, lower highs on your indicator, higher highs, although just barely, we do have higher highs on the price action. And this looks really interesting. And how do you get into a trade? Again, I'm a huge fan of breakout trading. It's very simple. It's very objective, especially with horizontal levels. So here we have a resistance turning into support and support again. Really nice confluence, and what we are doing then is wait for a pullback or a breakout, and then just trade it to the downside. So pretty simple, but very effective. And you can see, although this looks very simple, you have to wait quite a bit on the higher time frame for the divergence to turn up. Then you want to make sure that you have a divergence on the lower time frame. So although this may look simple, it is not as easy as you will see in practice, because a lot of patience is required, but that's the name of the game in trading. So let's see and fast forward a little bit. And let's see what happens. So no breakout yet. No breakout. Market is testing the lows again, and that's why exactly you want to make sure that you are waiting for a complete full breakout below the lows. That's just the key here with breakout trading and improving your trade quality, because then you have to avoid, and you can avoid, sitting through stuff like that, which is very painful to endure. So now you can see the market is breaking out with a very strong breakout candle. Let's think about how we could approach this. The entry theoretically here. Stop loss, in this case, you have again options as always. You could put it all the way above the high, or this high even, or just the breakout level. Again, I'm not a fan of the big extremes. I'm not a fan of the very close one. So probably we can drag it somewhere here in the middle between those two options. And for targets, we look left. We could think about, okay, here seems to be quite a strong support level. Here's a very big level. So let's see what this puts us. 1.8, 1.9, almost 2R, which is quite decent. In the beginning, I would recommend sticking to 2, 3, 2.5 reward to risk ratios. That's going to give you a pretty decent win rate, and also still high enough winning trades. We could also approach it in steps. For example, we take partial profits at 2, and then we're gonna trail our stop loss until we reach 3. Sometimes what you will see is that the market may reach your first target, may continue a little bit, and then you're giving back profits. That's why it's recommended to take partial profits along the way, or at least secure your profits by locking in something with your stop loss. So let's see what has happened and what this does here. So here you can see right off the bat a big challenge. Doesn't look too good for our trade, but you can see we are okay for now. And here we have now our move. So again, a tight stop loss will work some of the time, other times not. But the benefit of having a tight stop loss is that you may get your reward to risk ratio up much more high and much more faster. So there's a big trade-off: small stop loss, higher reward to risk ratio, but the win rate will also go down, of course. So this looks good for now. We are now relieved that we have survived this spike here. Now you can see the market is moving into the lows. What is it doing? Is it pushing through right away or not? You can see it seems like it. Under testing from underneath. Testing from underneath again. And here we are now at 3, 2, 1. So very interesting case study. Sweated a little bit here during the pullback, and overall a very nice approach. Double divergence, higher time frame, lower time frame divergence, and then a breakout approach on the lower time frames. Let's use a Bollinger Band for our third strategy, and what I like to do here is look for spikes outside of the Bollinger Band. So here you can see we have a pretty strong push outside of the Bollinger Band, so we are very, very far outside of it. And then we are also seeing a rejection candle. Here is a pin bar doji candle, which is showing us rejection and loss of momentum here. So this is quite interesting, and we could use that information to look for pullbacks. Very often when you see the market is trading outside of the Bollinger Bands, you have a move back. Very, very often this is the case. The stronger the move is, not always, but often, the stronger the reaction back into the Bollinger Bands. And it's a very interesting approach to test. And you can see that happening quite often. So that is the idea on the higher time frame. It's our higher time frame filter. And now let's go to the 1 hour time frame, turn off the Bollinger Band, bring our RSI on here, and let's see what we have. And we can again see our divergence. So we can nicely stack confluence, and that's the goal with any trading strategy. The way you want to approach a trading strategy is that you have multiple confluence factors together. So you don't only have a higher time frame, you don't only have a divergence on the lower time frames, but once you put everything together, you can potentially really increase the quality of your trading signals. So here we have the Bollinger Band, we have the divergence on the lower time frame, and the final piece to the puzzle is, for example, a breakout approach. So it seems like the market is giving us here this triangle pattern. We have our clear divergence here On the left, the market seems to be slowing down with the divergence, and what we are waiting for now is a breakout here. Again, breakout, pullback, whatever really is more appealing to you, you could decide to trade that. So let's fast forward and see what we get. No breakout yet. Not quite yet. Here we have now a breakout, so it's always recommended to wait a little bit longer and to really see that you are trading with the momentum and not here. This candle just barely crawled over the level, so that's usually what I try to avoid. And let's just look at a potential trade scenario. Again, stops, where do you put it? All the way here. Here's the last low, or right here. Again, just go somewhere in the middle. That is what I would do. And targets, let's zoom out and let's look left. We have options here. Oops. By the way, if you hold shift on your keyboard, you can make the line straight. I see people ask that in the comments quite a bit. You have a few levels that the market is offering here. So what I would like to do is see where do we hit 2.0. And we already get 2.0 here for the first level. So this seems to be quite a decent trade idea. Let's use that actually. Let's get rid and clean this up. So this would be a possible trade idea. 2.5, 2.4 reward risk ratio is pretty decent. And let's see what the market is doing. Not much. Retest has happened here. So if you are a retest trader, this is what you would love to see. You can see if we now break above this local high, then our chances are pretty good. And we have that. The market is unfolding. Not quite. So sometimes this will happen. It's not ideal, but the market is not just moving up and down in straight lines. And here we go now. Okay, so this took a little bit of heat, and you can decide how you want to approach that. For example, you could throw in a moving average. Probably for trailing a stop loss, a 20 period is a little bit more suited because it follows the price action closer. And you can see here, this is the SMA 20 period. You could have used that for trailing your stop loss along the way. And let's just see what would have happened if instead of a target or a fixed target, you would have just kept trailing your stop loss underneath the moving average. So we want to see when is the price action actually breaking below the moving average. Still not coming close, not yet. Here we are. So in this case, you could have gotten a little bit more out of it. Sometimes the market will breach through a moving average with a deep correction wave, and then you will be taken out earlier. But I think overall it's a worthwhile thing to explore if you're interested in a trailing stop loss approach, 20 SMA, and then use that on your lower time frame.